Welcome everybody. How to reduce risk and maximize your returns. I am Don Kaufman. A little formality also right up front. A risk disclosure here. We are not financial advisors or a broker dealer. We always mention that because I spent the previous 15 years of my career in, well, that business, in the brokerage side of the business. Copyright disclaimer, this is ours. This is not yours. If you want to replay this, well, we're going to give you a recording. A little bit about me. Again, my name is Don Kaufman, the co-founder here of TheoTrade. I've been trading for, started trading really in the late 90s. And right out of college, about 3 weeks out of college, I was invited to go to Chicago. About 2 years after I was invited to Chicago, I was kind of courted by a couple of individuals to join what at the time was a startup company. Startup sounded like kind of a cool term back in 2000. Anyway, I jumped on board over there. That company was called thinkorswim. Went through a couple of acquisitions. We were at the time in 2007, one of the acquisitions, we were one of a few unicorn companies. That was before the terminology unicorn even existed. It was $1 billion firm. And eventually we were acquired by none other than TD Ameritrade, where I resided for the latter portion of 5 years of my career. It's about 10 years at the original group of thinkorswim. We spent some years, of course, at TD Ameritrade, and ran the education for their 7 million clients. With that, done the tours of CNBC. I just like, you know what? If you're going to be pitted against somebody, that's the guy you want to be pitted against. It's Mr. Wonderful himself. I'm just glad I'm the one they gave the call over there to prior to that. For the record, when this one CNBC clip was taken, Apple was trading in and around $130, sold off all the way to 89. I was the short. It sold off to about 89 before, of course, where's Apple right now? Rocketed back up to the 170, 180 range. With that, a little bit about TheoTrade. So we specialize in education, stocks, options, futures. I mean, you name it. Like if you can trade it and it's a liquid product, we'll talk about it. All right. We're founded by professional traders, and all of us that work as instructors here at TheoTrade have a minimum of 15 years of industry experience. And we're really here. I mean, the way we develop TheoTrade, risk mitigation, that is controlling your risks in the market and really learning a skill set that's going to last a lifetime. Who is TheoTrade? One important concept, and I know that there's all kinds of educators out there. TheoTrade is not just, unique to myself. We have a number of key instructors here, including Doc Severson. Anybody familiar with Doc? We've actually got Jeff Bierman. Again, Doc specializes stocks, options, technicals. Jeff Bierman. Jeff actually is a professor as well at Loyola inside of Chicago. He's also a trader. He worked side by side with me at TD Ameritrade for 7 years as the chief market technician, which is a highly coveted position. I mean, again, TD Ameritrade at the time had between 7 and 8 million clients. We also have, of course, Steve Miller, 42 years stock options futures trader. Last but definitely not least, Tony Rago. He's a NASDAQ futures and intraday strategist. So let's get into this, what you're going to learn in the presentation. So you're going to learn, and we're going to start with this, why really a decade of poor fiscal reforms, quantitative easing, all right, it's left the U.S., both stock and bond markets, vulnerable to extreme bouts of volatility. And that's an understatement. And I'm going to state a little bit of a case for that tonight. We're also going to discover in a couple of steps, you can evaluate some of those impending risks and successfully navigate some turbulence in the markets. Now, how some of these risks, whether it's a 401k, an IRA, again, retirement accounts can be managed without having to unwind any of your current positions. So Then we're going to have a discussion here is, why volatility equals risk. Okay. We're going to talk a little bit about expected move. We'll talk about implied volatilities and again, discover opportunities, even the most docile markets. So you can be a little bit more consistent overall. Now, that sounds like a lot. We are going to go through a tremendous amount this evening. Let's get rolling over here. I'm going to start with this idea of kind of poor fiscal reforms. And if you were unfamiliar with a couple of articles I'm going to cite right off the bat. So if everybody's ready to go, because I'm going to fly through some of this with a lot of material. So this is a headline that just came out. And again, the source happened to be Bloomberg Markets, November 29th. Obviously, here we are in December of 2017. Goldman warns that market valuations at their highest since 1900. Returns likely to be lower across all assets in the medium term. Risk scenario sees inflation jump that ushers what we term fast pain. If you've never heard the term fast pain, what it basically means is everybody recognizes the markets haven't necessarily corrected in quite some time. They're talking about a fast, okay, and vicious market move. And here's a specific quote from that article. It has seldom been the case that equities, bonds, and credit have been similarly expensive at the same time. Only in the roaring 20s and the golden 50s, Goldman Sachs international strategist Christian Muller-Glissman wrote, okay, in a note this week, all good things must come to an end. Okay, there will be a bear market eventually, they said. So Goldman comes out with a big note last week, scares the marketplace. Okay, scares it for about what? 1 day. On top of it, this thing is December 4th. Okay, this is a major headline here, just goes by the wayside. The BIS. Most people have no idea what the BIS even is. Okay, what the BIS happens to be, it's the Bank of International Settlements. It's the Fed, okay, of the Fed. What that ultimately means, the Bank of International Settlements happens to be a global version of the Fed. BIS joins the chorus saying stock valuations are looking frothy. Okay, it says loose monetary policy is a key driver of asset prices. The central bank publishes quarterly reviews. Okay, stock prices are above historical averages, and U.S. companies may struggle to continue, all right, their pace of dividend growth, the BIS said in its quarterly review Sunday. So attached to this article, though, Nobel Prize winning economist Richard Thaler said in October, he can't understand why stocks are still rising. California State Teachers Retirement System CIO said that the holdings, the shares feels like we're sitting on a pincushion. By the way, this also happens to be from Robert Schiller in this particular article. Have Cape will fly. U.S. cyclically adjusted price earnings ratio at historically elevated levels. You have to realize how elevated these levels happen to be. This was one of the largest bubbles, of course, ever recorded. It's the NASDAQ bubble in 2000. But we are now, okay, into bubble territory not seen since, again, this particular span, which happened to be the roaring 20s. Stocks are like sitting on a pin cushion. It's exactly what we were referencing. Valuations have gotten worrisome, according to Chris Ailman. Now, this individual happens to run, he's the chief investment officer for the second largest U.S. pension fund, and they are poised to take profits. In fact, we're going to take some profits, Ailman said. We're going to batten down the hatches a little bit in case we have rough seas, but we're going to ride this out for a period of time. Next, by the way, that was also November 29th cited. None of this is being seen. Like I just picked out a couple of major Bloomberg articles and I had some fun with it. I stuck with Bloomberg. This one happens to be one of my favorites. Quants find stocks need a better hedge than just bonds. Okay, using a multi-pronged strategy boosts volatility adjusted return. Lots of hedges have disappointed, PIMCO says. The old recipe of using bonds to hedge against risks from equity holdings, okay, may not be a winner anymore. And investors would be better off with a more complex approach that relies on multiple tactics. That's from PIMCO. I am specifically, okay, going to be referencing this a little bit later. So I want you to remember PIMCO. So we're looking at PIMCO. We're looking at the second largest pension fund. We're looking at Goldman Sachs. the way, I want you to think about Goldman Sachs for a second. You think it's in their best interest to tell their clients, hey, batten down the hatches over here. We're going to get serious. All right. Of course not. They're all about assets under management. They don't want to lose assets. When you have like a second largest, pension fund in the US saying batten down the hatches, nobody is listening to these people. They have more money under management, than what? Well, there's only one larger US pension fund than them. Decisions have to be made. You must make decisions. What do you intend to do with your investments? Whether it's a 401k, whether it's an IRA, whether it's a long stock position. So out of curiosity, one of the first questions I'm going to ask you guys tonight, how many of you do have some, either a mutual fund, a 401k, any, exposure, to a long bias in the marketplace? How many of you guys have that in some way, shape, or form? And feel free to chat in as I kind of move along over here. So almost everybody has that 401k or an IRA. We're going to talk extensively about it. Now, this is not just about, it's not just about risk mitigation. It's not just about like, hey, how are we going to stop the bleeding? Should I bail out of everything? Almost everybody has this. And I just don't think people are understanding, the full brunt of some of the risks that they're facing over there. So the next thing I'm going to say to you is, listen, check your baggage at the door. Just set aside any preconceived notions of what you think can happen in markets. All right. I want you to set that aside, even set aside some of the articles. I just wanted to start with the articles tonight because to me, it was shocking. Those articles came out all in the time frame of just after Thanksgiving to the first week of December. And everybody's like, yeah, it's all right. Goldman warns. And again, I remind you that Goldman warning, PIMCO warning, the second largest pension fund warning, it goes on and on. It's not in their best interest to warn you. It is not in their best interest to warn you because that would then take assets out of their hands. And yet they're still warning. And that's what kind of freaks me out. Like nobody's picking up on that. So I say though, let's just set aside any preconceived notions. Let's come in here and say, all right, well, I've got a retirement account. But when volatility hits markets, your risk has to be in check. Good risk management starts with the perception that anything can and likely will occur. Prepare yourself for any event. I mean, how hard can the market be, right? We can go up, we can go down, we can go sideways. Anticipation of risk. All investments have risk. Learning to deal with those risks is kind of that key step forward. So when I say all investments have risk, what separates people from success or not success over there, it's literally how they deal with those risks. Before we go head on into specifics, on how to manage your risks, and we're going to talk about that. I mean, tonight we're going to talk about how to manage risks, and maximize returns. But before that, it's imperative that we spend time understanding effectively what are your risks. In order to do so, we shall discuss the use of expected moves. A little bit about implied volatility, a little bit about expected moves. So if you've actually seen some, of the webcast that we've done, I talk a lot about expected moves because it's critically important. So I'm going to run through this at a pretty good clip, and then we will jump right into how, again, to reduce risk and kind of maximize returns. Obviously, that's the theme tonight. Expected moves. You see, the reason I have to cover this first is risk, it can only be controlled if we have some measure of expectation. What do you expect? The first step in some of the risk management. Again, we're going to talk about these 401ks, IRAs, The first step in risk management, know what to expect and know what I call the unexpected holds. You're like, well, what does that even mean? I'm going to show it to you. What I'm referencing, it's probabilities in trading and expected move. Let's go ahead and get started. So some of you guys have experience with options. Others of you do not. That's okay. When I say it's okay, it's like if you have zero experience with options, great. We're just going to give you a little background over here. Now, I am not, and I like to always say this, I'm not here to tell you, you need to trade options. It's not what I'm here to tell you to do. But options, options can tell you a lot about what markets perceive risk to be. Okay. So there are now, by the way, there's about 15 exchanges. There's billions of dollars at risk. Option markets and liquid products have become really, really efficient. And again, you know, what do the option markets even tell you? I mean, what do they tell you? Option markets they're markets on future risks of an underlying product. Now, for those of you that know a little bit about options, right? If you know just a little bit about options, you know that there's options for different dates. Okay. So there's an option for 1 month, for 2 months, 3 months, and so forth and so on, right? I mean, what does an option for 1 month really do? Well, it puts a price tag on risk a month out. You know, what does it do 2 months out? Puts a price tag on what it thinks the risk is going to be 2 months from now. That's what prices options. Okay? Speculation and risk mitigation. When I say speculation, somebody says, I think the stock is going to go up a month from now, right? That's speculation. I think the stock is going to do this. That's speculation. Another trader turns around and goes, I think there's a lot of risk in this stock. Think about that. I think there's a lot of risk in the stock. If there's a lot of risk in the stock, options are probably going to be rather expensive. And if you learn to read risk, I'm telling you, it is one of the most invaluable resources you could ever have. So listen to what risk is saying. Risk on any given product translates to option pricing. Option markets are they place a price tag on your risk. Options speak volumes. Option pricing can then be extrapolated into stock price movement. You're like, what? Okay. If you take an options price, right? If you take an options price and you say this option trades for $2, okay? Where does that $2, like, how do they even come up with $2? All right. Well, in every trade, you have a buyer and you have a seller. Okay. There's a buyer or a seller, and the buyer and seller, they duke it out until ultimately they arrive at a price of $2. Like, a lot of people think that options are like, you know, some random, like, you know, it's a Black-Scholes model. It's Fisher Black and Meyer and Scholes. They did it to me. Okay. In the end, options are supply and demand. That's what I'm getting at. Options are supply and demand. Okay. Buyer's willing to pay $2. The seller's willing to sell it, you know, for $2. That's why markets have a bid and an offer. You know, the market could be like $1.95 at $2. All right. That's where somebody's willing to buy it, and that's where somebody's ultimately willing to sell it. And, you know, there's, again, equivalent reasons on both sides of that equation. You know, if the risk was really, really high in this underlying, these options wouldn't be trading for $2, would they? No, they'd be trading for like $5. And that's why I say options can be like this invaluable resource. And then you can take the option price and you can extrapolate it into stock price movement. Extrapolate stock movement from options pricing. It's one of the things that I want to start with tonight. Again, give it a little background. And I gotta tell you, I'm going through this at a pretty good clip because this is just background information I think you're going to need to really effectively understand what your risk is. Okay. And then we're going to show you how to reduce it and maximize your returns. To understand how options can define future moves on the stock, we need to examine implied volatility, right? It's pretty easy. Great. What can implied volatility do for you? Implied volatility. What can it do for you? Well, here's what it can do for you. And this is a slide I've been using for years to get people to understand this, right? So let's get right into it. This happens to be the volatility, 20%. Now, what that really equates to, somebody says like 20% volatility. Like, I know a lot of people have heard these terms, you know, there's 20% volatility. Maybe you guys have never heard that. That 20% volatility, though, happens to relate to what we term implied volatility. That's the volatility that's pricing options. Okay. So what somebody ultimately does is they say, 20% volatility, but they don't really tell you what 20% volatility means. Like, nobody says like, hey, yeah, like, okay, got a question for you guys. How many of you look at something called the VIX? All right. By the way, if you're watching this on a recording, you just like start screaming at the screen, yes, it's me. I look at the VIX. Like, a lot of people look at the VIX. Tons of people look at the VIX. They talk about the VIX constantly. You turn on CNBC, they're like, VIX, 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 VIX. Okay. And then they go, the VIX is 10. Okay. But they always say VIX is at 10%. First of all, the VIX is a volatility index. Okay. And then you go, but what is 10%? I don't know. It's the VIX. Okay. I don't know what the 10% is. Anybody ever wonder what that means? Well, here's what it means. So let's say the VIX was at 20. Well, here, if you have a $100 stock, this is a $100 stock, and it doesn't matter what stock it is. I always call every stock is called stock. Okay. It's called stock. So what volatility really equates to, it extrapolates the stock price movement. 20% means 20% of 100. That's it. It just means like, okay, it can move up to about 120 or it can move down to about where? 80, right? That's it. That's what it means. And it's supposed to stay in that range 68% of the time. Now you're like, whoa, guy just pulled 68% out of nowhere. Okay. Well, no, that is what we call one standard deviation. 68% of the time. So this happens to be what volatility really equates to. So when somebody says that the volatility is 20%, or let's say the VIX, if the VIX is at 10% and it was a $100, product, it means it can't move up to 120. It means it probably can only move to 110 or down to about 90, right? That'd be a VIX at 10%. But if the VIX got to 20%, that means it extrapolates what? Movement almost twice as far. So why is this so important? Why is that so important? Because if you know the volatility, you can instantaneously kind of handicap how risky a particular product happens to be. You guys tell me, what's kind of a risky underlying? Like, what's a risky stock? What's a risky stock to you? Anybody? So I like it. Somebody said Amazon. All right. We got a Chipotle. Actually, ironically, Amazon really isn't a high risk stock. There you go. GE, I love it. GE is a risky stock only because it continues to go down. Got a bunch of Teslas in there, Netflix. Okay. I love it. All the stocks that are coming in, like half the people say Amazon, the other half are Tesla. Nvidia, good one. Good stuff. But in a second, I want you guys to don't worry about the 68%, which is just, that's not everybody went and took a bunch of statistics classes. That's just what we call a normal move. It's supposed to move in that range, okay, normally about 68% of the time. But what's cool about this is implied volatility, okay? What does it really do? How do you use this every single day? Who cares? It's 20% implied volatility. The bottom line is, how do you use this stuff? Implied volatility can be extrapolated, okay? That means plotted into stock price movement, or what's termed expected move. If you know what the volatility is, on a $100 stock, you can say it can move up in the next 30 days, the next 60 days, the next 90 days. If you know what is termed, okay, implied vol. If you know the implied volatility, okay, you can extrapolate how far the stock is supposed to move within a given period of time. And that is termed expected move. It's huge. And I'm going to show you a little bit about it. Okay, expected move and probability. Expected move defines a one standard deviation move in a given underlying. Therefore, there's a 68% probability of an underlying closing inside the expected move by a designated expiration. Now, so why am I talking about this? Why did I talk about this? As I said, you walk into some stock and you're like, well, I trade some Walmart, or I trade a little bit of Google, I trade some Tesla, or somebody said, Intuitive Surgical, and use this stock and that stock. And you walk into these stocks and people are blind. They start looking at the chart. Yeah, I got me a MACD. I got me a Fibonacci. It's a Bollinger Band. Yeah, you know what though? The options market, I want you to think about this for a second because it makes me crazy. The options market literally puts a price tag on risk. 15 days, 22 days, 29 days, 36 days, 43 days. Does a Bollinger Band do that? Hell no. This is skin in the game, people. There are billions and billions of dollars making markets in here. And why do I trust option pricing? because the option pricing has skin in the game. There's money being traded, all right? And when there's money being traded, it makes these numbers efficient. So you could look at a ton of different expiration cycles and options. And again, even if you're not like an options geek, it's fine. But you can look at it and it'll tell you, all right, how far the stock is supposed to move. It doesn't even matter what stock this is. Check this out. Whatever stock this is, I just took a screenshot, right? Whatever stock this is, in the next 22 days, it's supposed to move $9.32. Now, okay, I'm not so sure about that. Let's check it out. Expected move in U. Not every trading application has expected move. You can use what's termed the at-the-money straddle as an alternative to the expected move. Add the at-the-money call and the at-the-money put for any selected expiration cycle. And you're like, what? Here, okay? What I'm doing is, again, doesn't matter what stock it is. All you got to do is add, okay, the calls to the at-the-money puts. Now, this stock would be trading right at around 149. And if the stock is trading at 149, add the 149 calls to the 149 puts. That would be $9.93. And you can see this is the actual and real expected move. It's about $10.17. All I want to start with tonight is to give you a quick and rough feel like, hey, this is my risk. Like if you knew that your risk in some stock was $10, like that stock is this $149 stock, and that stock was supposed to move up $10 or down $10, right? Now think about that like on a distribution curve, right? It's supposed to move up $10 or down $10. Like, how could you use that? How could you use that? Well, the first thing is I probably wouldn't want to put a stop order in down $5 because then you're going to get stopped out. Because this stock is supposed to fluctuate $10 higher, $10 lower, okay? There are so many different like ways to use this. You could turn around and tell me, you could tell me like, how else could I use this? Well, Don, maybe I don't want to take $10 of risk. If you're not willing to take $10 of risk, I am sorry. This is the wrong product for you. It just is. There's nothing wrong with saying that. I mean, look at the implied volatility opportunities. Understanding volatility and expected move, it's a step in the right direction, okay? Your understanding of these metrics can take your risk management to the next level. Now, the reason I start with this tonight, if you understand what I'm talking about at this point in the game, okay? If you understand what I'm talking about, you can immediately identify what you're stepping into before you do any trade, any investment. You could even theoretically do this with mutual funds. You got your 401k. You could even do it with mutual funds, and I can show you how to do that as well. So let's explore implied volatility on a couple of products. I put Tesla in here and the SPX and Walmart and Google. Let me just show you. All right, look, proof is in the pudding. So here's SPX. If you guys are unfamiliar with the SPX, let me take you to it. Right here is the SPX. It's the S&P 500 index options. It's a kind of a cool way just to look at the full S&P. I took this screenshot today. Look at the S&P tells us. It tells us what the risk is one day for 4 days, right? Why? That's Friday. Then there's Monday. Then it tells us the risk next Wednesday. Then it actually tells us the risk for Friday, and then Monday, and then Wednesday. And then look at this. It has so many different expirations. You have to understand the market now is handicapping risk almost every single day. Almost every day. Did you know that in the next, did you know this? In the next, let's say, let's have fun with this. In the next 11 days, the market is poised to move higher or lower $33. That's it. That's not that much. $33 in the next 11 days. Does that help you? Go fish. I say go fish because, does that help you? Of course it helps me. All right. If the market's not poised to move all that much, maybe I'm not taking as much risk. But then let's go look at Tesla. How could this help me in Tesla? In Tesla, look, it's a $311 stock as of right now, and it has 35% implied volatility. Now, back up for a second. Back up. If you looked at the SPX had 9 volatility. 9. Next page, 35. What can you say about Tesla? Okay. Tesla's like a wild child. I mean, Tesla's almost, what? 3 to 4 times the risk of the S&P. That's the way to look at it. Like, I want you to immediately be able to equate risk. Tesla, okay? What's a not so risky stock? Huh? Anybody? What's a not so risky stock? Let's have some fun with this. Here, out of these stocks, what doesn't look risky? I put up a couple of stocks over here. I have Tesla, Facebook, SPX, Microsoft, Walmart, Google. What's not that risky? Okay. All right. A bunch of people are saying Walmart. All right. So let's go check it out. So there's the SPX. Here's Tesla. Tesla's 35%. Here's Walmart. Walmart is about 16% volatility. That's it. It's about 16% volatility. So you're like, oh, okay, well, let's, a little less than half a Tesla over there. I get it. But it's also, Walmart's still almost double the S&P. But then you look at Google. Google kills me because Google, all right, Google's volatility is not dissimilar to Walmart. What a weird world we live in. What a weird world we live in. We're now comparing like Google volatility to Walmart. You're like, it's Walmart. All right. You can buy like diapers, underwear, a couple of pairs of shoes, maybe some snacks over there. Well, pretty much it's Walmart. You can buy anything, right? And then you look at Google, which is like the tech company of all tech companies. And the interesting thing is when you start equating the risk to one another, like, is anybody surprised by this? The volatilities are almost the same. The market looks at Google similarly from a risk standpoint as it does Walmart. And to me, that's totally shocking. And that's what I wanted to kind of open with, a little bit about implied volatilities, because not enough people understand this stuff. Not enough people are using this on a day-to-day basis as what I said, handicap kind of your risk. Now, let's get to it. It's where the rubber meets the road. Now that we have a foundation of what risk is, right? Risk is kind of like looking at those volatilities. Let's do something about it. Okay. And that's what we're really going to do over here, because you got to build a foundation to anything. I know everybody wants, listen, every class I've ever done, everybody wants instant coffee and instant tea. They want, I just want to be told what to do, Don. Okay. But you got to have a foundation behind some of this stuff. Core strategy and trade logic. Today specifically, I want to introduce you to one. It's a real world strategy that you can start using immediately tomorrow, right? We're going to talk about reduce risk and maximize returns. Okay. What if I could teach you one strategy to allow you to remain in the markets with considerably less risk? You're always going to have some risk, guys. We started with that. But if I could teach you one strategy to remain in the markets with considerably less risk and still provide upside potential, does it interest you? Okay. It should interest everybody, because we started tonight and we're talking about, your 401ks and your IRAs, or, if you're Canadian, it could be a Canadian, IRA, which I'll actually reference it specifically here in just a moment. But think about long stock or mutual funds. And again, almost everybody has these in some way, shape, or form. If you buy stock or have a mutual fund, the following is your risk. Let's just talk about what your risk is. And the way that I built this, and I thought this was effective, and hopefully it is for some of you. The way that I built this, I went in and I built a risk profile. This is just a risk profile. That line is your risk profile, okay? And I did it on the spiders, okay? So for those of you, if you're familiar with the spiders, and I think almost everybody is, a SPY is, okay, an ETF of the S&P 500. It's the S&P 500. So the reason I talk about the spiders is people are like, well, no, I have a mutual fund. Okay, I get it. You have a 401k that has a mutual fund. The mutual fund probably has a very high, what we call correlation or beta. Beta is the relative risk of your fund versus, for instance, the S&P. Your mutual fund correlates probably directly to the spider. Now, but it's kind of funny because if you have a mutual fund, they never compare it. They go, oh, your mutual fund's performance versus the S&P. If you guys actually have mutual funds, you get the prospectus. They put in there what's called like the Lipper Index. Nobody even knows what the Lipper Index returns. You know why they use the Lipper Index? Because the Lipper is so bad that the mutual fund can outperform it. I wish I was joking with that. I mean, not. Look it up. The performance is absolutely horrific, but they're allowed to benchmark to the Lipper. So what I did in here is I took the spiders and I said the following SPY position is the resulting risk if you had owned 1,000 shares. Now, let's be clear. The spider's not cheap, right? The spiders happen to be right now about a $265 product. If you went out and bought 1,000 shares, this is the same as having a $265,000 portfolio, okay? Which some of you guys do. But I just want you to see the risk. Like, this is the risk of a $265,000 portfolio. So if you had a 401k with 265 grand in it, this would be your risk profile, okay? But if you had it with $26,000 of risk in it, well, okay, this is your risk profile minus one of the decimal points, right? That's it. That's the only difference. Even a relatively docile volatility, okay, relatively docile volatility event can cost tens of thousands of dollars. So here we happen to be at 265. Now, this happens to be right in this neighborhood here, okay? If the spider is sold back off to 215, if the spider is sold to 215, you lose $50,000. That's it, right? If the spiders come down to 230, okay, in that neighborhood, you lose about, it's about $35,000, okay? All I'm getting to is the risk is absolutely phenomenal. And the reason I'm mentioning like 230 or 215, you go look at a chart here in a minute and you realize we were there, okay? Like this summer, we were there. If the market's just sold off right now to where we were this summer, do you realize people are going to give up $35,000 of upside? Okay, they're just going to hand back $35,000, or they're going to hand back $50,000. Okay, your retirement accounts are looking pretty good right now, and that's why we are talking about this. Okay, stops, they're not going to save you. Okay, sure, you can use stops. Are stops really going to get you out at the price you intended? Like, are stops going to get you out at a price you intended? Maybe, unless of course you get a fast move down. Okay, will stops be there to save you in the event of a major market correction in a short period of time? Of course not. Can stops control risks on your 401k or mutual funds? Oh, the last I looked, listen, I was in the brokerage business for 15 years. You ain't got no stops in here. Stop with the stops. There's nothing definitive about using stops to mitigate risks. Okay, and I'm not trying to pick on you for using stops. I'm saying there's just nothing definitive. You know, by the time you would be able to get out of something, you could be taking 10, 15, 20, even 30% losses. And that's the point that we have to make. And that's why I put in stops will not save you. Okay, learn to lock in your gains. Learn to lock in your gains. What if we can add a risk reduction strategy to your existing portfolio to limit downside exposure? You're going to lock in your gains and allow you to keep most, not all, but most of the upside potential. Why aren't you doing it already? And that's what the big question is here. All we're going to do is we're going to add a small risk reduction strategy. It's just a small risk reduction strategy. It's going to, limit the downside exposure. You hear me use this word hedge. If you hear me use the word hedge, I use hedge. I talk about risk mitigation. Everything's about controlling risk. It's about limiting downside exposure. That's what the hedge means. Limiting downside exposure. It's not the bush out inside, your house over there. And when we were, I was referencing earlier like Goldman Sachs, and I talked about PIMCO, and PIMCO, what did they say? They said a classical risk mitigation tactic of using bonds ain't going to work. It said specifically you had to get a little bit more complex. This is a little bit more complex, okay? You're one trade away from this. Instead of the aforementioned risk profile, what we're going to do now, here is the same 1,000 shares of the spider, okay? This is the exact same 1,000 shares of the spider with an added risk reduction strategy. Much of the upside potential. But what's the downside risk? We're actually going to cut off our downside risk. We're actually going to leave much of the upside potential in here. Now, you see there's a little what we call whoop-de-woo over here. That's because you have to give up. You have to give up some of the upside, in essence, to be able to protect some of the downside. And that is critical to understand. But what looks better? Let me go back a few slides over here for just a second, and you decide, okay? You can lose 50 grand going back to the 210 level or 215 level, okay? Or, okay, you can go all the way back to what? 0. You can't lose more than about $5,000 here. That's it. This is on 1,000 shares of the spiders, okay? Again, this will hedge you, all right? This will hedge you in the event of a sudden downdraft in the market. It'll hedge you in the event of a slow downdraft in the market. It is not going to be using stop orders of any kind. All right. Somebody mentioned about futures. Don't worry about futures. You don't have to use that. Okay. Welcome to the atomic hedge strategy. The atomic hedge strategy is the purchase of put options in order to counter downside risks on a long portfolio. Anybody could have figured out that this is put options. Okay. If anybody could have figured this out, what we're going to talk about, though, is what's the right options to trade. That's the whole key to anything. And I'm going to explain this in a lot more detail for those of you that are kind of brand new. The atomic hedge strategy is the purchase of put options in order to counter downside risks of a long portfolio, 401k, an IRA, any tax-deferred account. And I know what people are going to say. I can't trade options in my 401k. Do you think I'm new? Of course I know that. Okay, you can't trade options in your 401k, but you can trade them in a regular taxable account. You can trade them in an IRA. Okay, you can hedge one account against the other. The put options are financed through selling, okay, out of the money call spreads. The put options are going to be financed. You can't buy put options because they're just too expensive. All right, so you got to finance it by selling spreads against it. Sounds easy enough. However, this trade needs to be absolutely precise in order to correctly counterbalance your individual risks. Here's an example of the trade. What this happens to be is we bought, okay, on 1,000 shares, we bought some contracts of what? The 260 put. Then we actually sold, okay, a call spread against it. The entire trade was actually done for a 5-cent credit. Now, this is not something that's like, brand new. Traders have been using this strategy decades, since like the late 70s, okay? We have now put it together, though, in one conglomerate. Like, nobody ever teaches this one customized strategy over here. That's what the atomic hedge happens to be. Again, this is important stuff. Now, I'm going to talk a little bit in detail. Assume that the spider is trading at 264. And again, we own 1,000 shares. Okay. What we're going to do is we're going to go out and we're going to purchase a 260 put. Now, for those of you that have no idea what a 260 put is, here's 260, right? Right in that neighborhood right there. There's 260. We're going to turn around and we're going to buy, okay, a 260 put. What does the 260 put give us the right to do? Gives us the right to what? Sell the SPY at 260. So bear with me here for a second. If the spiders go up, let's say the spiders, they're at 264. If the spiders go to 270, do I have to sell at 260? No. I have the right to sell at 260. Do I have to sell at 260? No. If the spiders go to 270, great. They go to 270. I make it, right? What if the spiders go to 280? Do I have to sell at 260? No. Okay. So if the spiders go to 262, all right, 262, do I have to sell? No. What if the spiders go to 240? Well, you have the right to sell them at 260. Everybody else has to sell them for 240. What does it save you? Okay. Saves you about what? $20. That's what you need to focus on first and foremost. If you've never seen a hedge, okay, focus on the puts. It seems easy enough. And that's the part that everybody kind of gets. You buy the 260 put. Buy a put. All right. You buy a put. What is it? It's a hedge. It's your risk mitigation. Now you go, somebody's going to say, I don't own the spiders. That's fine. You don't have to own the spiders. You own a 401k. In that 401k happens to be a fund, or it could be a fund of funds. All you have to do, okay, is know what's in the 401k, and we can tell you exactly which puts to buy. Maybe you have a fund that's heavily into tech. Well, I can show you which puts to buy. We'll tell you exactly what puts to buy, and then we have to tell you how to finance the cost of those puts. And financing the cost of the puts, we're going to go out there and we're going to sell, okay, because the cost of the put is formidable. So we finance the put by selling call spreads against it, okay? We finance the put by selling call spreads against it. And we're doing this, again, we're doing this for even money, or what's called a net credit. Why? Because the cost of puts is outrageous. You can't just go out and just try to buy puts, because if you just buy puts, the puts are going to cost you more than the upside potential of the stock. So we finance it, okay, by selling something against it. There's not a lot of margin in this trade. It's not going to kill anybody to do this thing, okay? It is going to cap a little bit of your upside. So it controls some of the upside. But you know what? Who cares? Look at the strategy. Here's the same 1,000 shares of the spider with an added risk reduction. This is with this atomic hedge, okay? Much of the upside, all right, but with limited risk. That's what this just ultimately did. It took us from pure risk to what? Less than $5,000 of risk. And that's totally critical, all right, for most people. And this is where, you know, if I ask the question like, okay, how many people are doing this right now? Everybody goes, I don't really know. I don't really know. And it doesn't matter. Whatever kind of portfolio that you have, you can do this on. All right. Whatever kind of portfolio you've got, you can do this on. And that's where, again, it's invaluable applications for the atomic hedge. The atomic hedge can be used to counter risks in the following accounts. So if you have a portfolio of stocks, right? You just have a portfolio of stocks, we can hedge mutual funds, no problem. But you have to know what's in the mutual fund. 401k, okay, great. IRA, no problem. Canadian TFSA, right? That's a Canadian version of an IRA. In any of these, you could actually reduce risks. That's what this strategy is just designed for. The other aspect I want to look at, even if you just had a big position on a stock like Google, you actually own Google stock, you could actually use an atomic hedge on it. You know, what other stocks might you own over there? Somebody said Microsoft. Of course, you can do it on the individual stock. This is not limited to just the spiders, okay? The limitations out there it's really boundless. As long as you're trading relatively liquid products, but in mutual funds, they're not even liquid. And again, they don't have options on mutual funds. So what we're going to do, okay, is we're actually going to teach you in the mutual fund to correlate the mutual fund to an ETF product or index. So what would that be? If you were tech heavy, you could use something like the QQQ, right? If you were in energy stocks, you're like, I'm in all these energy stocks. Here's the XLE. Okay, I could go on and on and on all day long with how and what products to correlate over here. And you're going to find out these correlations, they're perfect. It's great for being able to hedge and reduce your risk. Now, continuing on over here, some of the characteristics of the atomic hedge. You know, the attributes of this thing are undeniable. Again, if you want to limit your downside risks while maintaining an upside potential, like think about the markets right now, right? You need to learn to do this. Risk is limited to precisely your comfort level with this thing. You don't need a stop order, okay? The probability of profit's high. Why is the probability of profit high? Because we're not impeding upon whatever it is you have. We're not impeding upon it. You know, if the underlying goes up, great, you're going to make some money. If the underlying goes down, you know what? You're going to hedge. That's why the probability of profit high. It's the perfect spread to reduce risk of the stock portfolio. And it's an excellent tool for those seeking returns, yet desire reduce risk. Like right now, you know, I said earlier tonight, check your baggage at the door. I showed you the report from Goldman and from PIMCO, Okay, and from the CIO of the second largest pension fund out there and the Bank of International Settlements. I showed you all of those. It's not to scare you. It's to tell you that the biggest firms in the street see risk ahead, but then I turn around and say, check your baggage at the door. Who cares what they say? Maybe they're going to be wrong. So if they are wrong, well, hell, we should have upside potential with reduced risk, and that's what this thing affords you. But you got to be able to build the atomic hedge. Do not let options intimidate you. The spread below is being done for a 5-cent credit. And, you know, I use this analogy all the time. Trades like this, okay? The only way to think of a trade like this, it's a power tool. And I always give you the analogy, it's like a massive chainsaw. I mean, if you're going to go out and you're going to cut down a tree, you can go out there, you can use a handsaw. It'll take you 3 days. It'll be extremely dangerous using a handsaw. Or you could use a massive chainsaw. Now, if you don't know how to use the chainsaw, you're going to lop off a couple of fingers. And the exact same thing is relative to the atomic hedge. I mean, there's a couple of reasons, by the way, we call it the atomic hedge. I'll get to that. But used correctly, it can be extremely effective way in creating returns and reducing risk. Used incorrectly, you're probably going to cut off a couple of fingers. You know, I always show people precisely the trade that I intend. Okay. But, you know, there's still this fear of it. And fear not the atomic hedge. Again, you may not know options or have limited options experience. Okay. And if you've never placed a trade, that's fine. We can show you how and when to place the atomic hedge in a matter of a few hours. Okay. Everything that we do here at TheoTrade, it's about detailed recipes for every strategy, including the atomic hedge. Okay. You know, you have to look at putting a trade together like baking a cake. It's a recipe. That's it. It's just step 1, step 2, step 3. You know, people, well, do I really need the recipe? Like, look, for this market, you need the atomic hedge. I just wanted to throw this out there. Okay. And again, this isn't about like, you know, let's not, scare you to death. You don't know what this future out here holds. Okay. This is 20 years of the S&P 500. Most people right here, I was working already in the industry. I started working in this industry in 98. Right here, I was already working at a little brokerage firm called thinkorswim. I watched people lose 50% right there. Okay. But, oh, don't worry. They got back to even. Okay, by basically late 07. Basically to give it all back, and they lost 50% again, you know. But don't worry. The brokerage firm says you should be in it for the long haul. I mean, come on. If your retirement was in what, 08 or 09, I guess you're not going to retire to get that 50% back. But hey, don't worry. It came back with a vengeance. Like, this scares the hell out of me. Okay? You think, well, like, this is worth learning how to reduce your risk at this point? I don't know. You can still have upside potential, but if the market's going to absolutely tank, I don't know, 1,800 looks like a pretty reasonable number. I mean, if you looked at this chart, if you legitimately looked at this chart a year from now and we were right back here, would that surprise you at all? All right? No one would be surprised by this. No one. Okay? I mean, I'm going to get to some of the questions because the questions are flying in here. And we look at this and it's, you know, it's a pretty straightforward strategy, but everybody always asks, why doesn't everybody do this? I mean, it's a fair question. It's because you need to know quite a bit about it. I mean, you can't just go out and say like, that's it, I'm going to do it. You need to know, how many contracts do I trade against my 401k? Can I do this in a tax-deferred account? The answer to that one is yes. Of course you can do it in a tax-deferred account. Okay. How far out of the money should I buy the puts? How many calls do I sell against the puts? All right. What do I need to do when the puts go in the money? That is, you know, those 260 puts that we had, 260 puts give you the right to do what? Sell the stock at 260. You don't even own any stock. You've never owned the spiders. You just have what? You're like, I have a 401k. I don't know what to do. We have a 260 put with the underlying trading at 240. That thing is going to be worth $20. You better know when to get out of this. Should I worry about dividends? What about dividend paying stocks? You know, you own some IBM, you got a little GE, okay? Throw a little Tesla in there. That ain't going to pay a dividend. But you know what's kind of cool? You're still getting paid dividends, but you can hedge yourself. You can reduce the risk and still collect the dividends. Do you need to actively monitor this trade? I'm going to give you an answer for that one. No, you don't need to actively monitor it. Can I set good till canceled orders for the atomic hedge? Yes. Okay. The reasons that people don't do things because they just don't know how to do them. I mean, you can Google out there how to hedge your portfolio. Seriously, you can Google, how do I hedge my portfolio? It'll say go buy puts. It'll show you how to do a collar. It is not going to show you how many contracts to use. It's not going to tell you how far out in expirations. I mean, that's what we do. It's criteria. It's what we do here at TheoTrade. We build the recipes. I mean, trading's about answering the what ifs. What's the correct options expiration for this? Did I use January? I use January in my example, but maybe we can go further out. Maybe go 3 months out. How much capital will I tie up with this atomic hedge? Okay. What call strike price options do I sell? How many? What strike price options do I buy against the calls that you sell? How much risk can I limit in my portfolio with this strategy? Like if you have 250 grand, you have got to be able to answer these questions. Okay. You have got to be able to answer these questions. We have the answers to all the questions. That's what the detailed recipes look at all the angles. Again, our TheoTrade recipes look at all the angles of the atomic hedge strategy. We're going to provide the following within this criteria. What index product, ETF, or stock we can build the atomic hedge on. Precisely what put options to buy and which call options to sell and which call spreads to sell. The correct options expiration to build the atomic hedge. We'll show you the allocation model. Why? It's whereby assisting you in selecting the number of atomic hedges to place for your portfolio. Everybody is individualized. Your portfolio is different than anybody else's out there. What do you do in order to manage the trade and place hedges consistently? Never leaving the nest egg exposed out there. And that's what we do. We have your answers. TheoTrade has the answers to your trade-related questions. Again, all the recipe, it's got a definitive checklist of criteria, each strategy, and each unique variable that you're going to encounter. Basically, how, when, why, at what price. It's just the beginning of some of the variables that you're ultimately going to face using this atomic hedge. By the way, if you haven't realized this, the atom, this is actually your portfolio. It's the nucleus. Okay. Ultimately, the electrons circling it are the hedge. That's it. That's why it's called the atomic hedge. If people were kind of curious about that, that's why I started calling it the atomic hedge. It's ultimately being surrounded and it's hedging the risk ultimately of the nucleus. And that can go wrong if you're not like equipped to know how many contracts, but the secret's in the sauce. Everybody thinks, I can read about these spreads anywhere. And think again. Again, the strategy and the corresponding criteria, it's the utmost attention to detail. And we spent months fine-tuning this. And this differentiates, from any other strategy that we have done here at TheoTrade. Okay? By far, differentiates. And I'm going to look at some of that. So if you want the criteria, okay, to the atomic hedge, we are going to do a class on this. Okay, the class is ultimately coming up here, and it's coming up live on Saturday, December 16th. It's at 10 a.m. to 1 p.m. Eastern time. Of course, the class is recorded. Okay, it's $197. It's theotrade.com/blueprint. I will be the instructor for this. The class will be archived immediately after it, okay? Because somebody's like, is it recorded? I can't make it on Saturday, December 16th. The class slide deck that includes all the entry and exit criteria and all the checklists is available, okay, immediately for download, okay? It's actually prior to the class, but you can download this slide deck. It's a PDF file at any point, okay? And it's, I've done a lot of classes over here, and I'm actually going to compare this to a couple of other hedges. Hedging is such an important portion. And no matter what we do, like people just don't get it. I mean, listen, most people are going to sit there, okay? And I'll come back to that in a second. Most people are going to sit there and they're going to take this for granted. They don't care. You're going to take it for granted. They're going to ride it out. If you're watching this right now, we're doing everything we possibly can. Listen, I don't know what the future holds, but I can tell you one thing. Okay, there's no volatility in the market right now. There hasn't been any volatility in years. Do you think that's actually going to be your future? Do you think the future is absolutely no volatility? Now you can pack up everything you got and you can put it into cash, but cash is not going to be a good hedge. Okay, because you know what? We could explode to 3,000 on the S&P. You need to have that upside potential, but still the downside risk mitigation tactic. And you know, again, do everything we possibly can to bring risk mitigation to the table. I know everybody's like, oh, I just want to learn to make some money. That's great. We've got tons of strategies that teach that. But I'm telling you, you want to save your nest egg, you have got to learn this stuff. There's going to be added bonuses for the class. There are 3 bonuses. The bonuses are worth well over 197 bucks. I don't say stuff like that. Listen, Options 201. Options 201 is about vertical and calendar essentials. I needed people to watch Options 201 prior to coming into this, okay, simply to understand the vertical. The second bonus, though, on here is Option Greeks. It's Delta Gamma Theta Vega. It's a position management class. This, okay, easily is worth the 200 bucks, okay? Then, on top of it, there are 2 separate additional courses, a guide to hedging and capital allocation class. Okay. So these are, you know, they're bonuses. These are like kind of like prerequisites. Sign up for the class tonight and start watching this stuff before even going to the class. And I'm stressing to you, you will be blown away by the beginner's guide to hedging. You'll be blown away by that hedging course alone. The capital allocation class, okay, it's going to give you a whole new look at what you should be doing in terms of allocation in, again, today's marketplace. So again, I'm going to show you the course curriculum over here. Again, the whole thing's 197 bucks. And there's going to be people that have, you know, 50,000 or 100,000 or even $20,000 at risk that don't want to take the time to learn to mitigate the risk. You got to realize the risk is on you. Like, nobody is going to do this crap for you. You think mutual fund managers, what do they care? All they care is about assets under management. It's been 15 years in the brokerage industry. Okay. You know the most important thing to a brokerage firm? Getting to $1 trillion in assets. That's it. Why? Because they know exactly what they yield on $1 trillion of assets. It doesn't suck to have $1 trillion in assets. Okay. And they sit there and they go, well, market could crash, but screw it. We still have $1 trillion in assets over here. I don't care. If you don't take like initiative to mitigate risk, to control risk, then what are you going to do? Again, you can get into cash right now and somebody goes, I'm going to dive into bonds. That's the problem with 401ks. 401ks are going to force you to go into a bond product. You can't go to cash in a 401k. You got to go to bonds. Guess what? If you read that article, PIMCO even said, PIMCO is the bond kings, people. Nobody's better at bonds than PIMCO. And even after the bond king himself left PIMCO, they found a younger kid, his protege. He's even better. Okay. And they're telling you right now, definitively, that bonds ain't the hedge to go into, that you have to do something a little bit more complex. With that, TheoTrade.com/blueprint. Here is a little bit about the curriculum. We're going to talk about in the class how to build the atomic hedge strategy to protect the nest egg. Okay, why your retirement accounts are at risk of massive losses in the current environment and how to curb those risks immediately. Of course, reducing risk, 401k, IRA exposure, even if you can't trade options in those accounts. Again, the life savings is at risk. How to hedge your portfolio from turmoil so you don't repeat 2000 or 2008, doesn't wipe out your retirement or even a fraction of your retirement. How to maintain upside potential while controlling downside risks. And again, there's nothing, let me tell you something. There's nothing sexy, okay, about like, hey, let's control our downside risk. Doesn't have to be sexy. It's your nest egg. You got to keep it. The one strategy is going to help you sleep at night, okay? All right, when to open, when best time to close these things. It's criteria, what strikes, what expiration. It's all a step-by-step workshop, okay? How to what? Systematically add this strategy to your trading arsenal out there. So I'm going to answer a couple of questions up here. And later, I'll throw the address up here. By the way, we're here. We are here. You can just, click on this and you can start talking to us immediately. All right. If you have questions right now, you can fire those questions in. Again, the class is what? Okay. The reducing risk and maximizing returns blueprint. I also, like, I urge you, you can, shoot an email to us anytime, but I don't want you to go to the class and feel like that's it, you're on your own. If anybody has ever emailed us, fine, support@theotrade.com. You can ask me questions directly. You can also give us a call. Now, I don't usually pick up the phone because, I'm out there, I'm trading and so forth, but I will answer your email, and it's me answering the emails directly, okay? Again, all the curriculum is in here. The bonuses, these bonuses, again, you can start watching them right now. All you got to do, add to cart, start watching the things right now. Let me answer a few questions because there are a ton of them. Somebody said, start with, Roger said, what about international ETFs? Of course, okay. International ETFs, you could use anything from like Brazil, EWZ, Japanese risk. If you have a lot of Asian exposure, EEM. All right. So how does this compare? How does this compare to the risk twist trade? We actually did a class with a major like hedge called a risk twist. The risk twist, okay, provides, again, downside protection for a portfolio. Absolutely. This is much more designed for that 401k, the IRA. It is a completely alternative risk metric. The thing about the risk twist, you have to have at least about a 5 to 10% down move before the risk twist really kicks in. This, okay, is only going to need about a 2% decline before it kicks the hedge in. So this strategy is far more, okay, risk-centric in that it immediately kicks the hedge into gear. By the way, I can't stress enough, no matter how many different hedging strategies, believe me when I tell you it's worth $200 to learn another one, because you can actually use a multitude of hedging strategies. One other aspect I want to bring to light with this, okay, before I go any further, before any other questions, we're going out there and we are buying, okay, for instance, a 260 put. We're buying a 260 put and then financing the cost. You could just use the strategy itself, okay, as a bearish strategy overall. You don't have to use this against a portfolio. If you do not have a portfolio, why not just use this as a bearish strategy? Absolutely could. Okay? You can use it and say, bring it! The markets are going to tank. I mean, again, a lot of people are going to look at this, yeah, whatever, it's another class. I totally get it. But at the same time, we're showing you something right now that you can use to control risks of a 401k IRA and your nest egg. And as I say, challenge people a little bit. Most people do absolutely nothing, and they're going to sit there and they'd be like, yeah, I guess I'm just going to lose, 30% of my portfolio again. And it's insane. I mean, I get pretty heated about this because I spent 15 years in the brokerage industry. What I saw in like 2007, 2008, I mean, people, if you watched the movie The Big Short, and you think that only 5 or 10 people knew that the market was going to tank, are you kidding? Everyone in the financial industry saw it coming. Everyone saw it coming. In 2008, okay, the phones are ringing off the hook. Everybody's like, the summer of 2008, the market's already started to slide a little bit. Everybody's like, yeah, we should probably get out of everything. They didn't do anything. Most people didn't do anything, okay, because you never expect it to be as bad as it's going to be. I don't know what the future holds, and neither do you. That's the irony, but I do know this. We're in a rising interest rate environment. The Fed meets next week, okay? Taxes are going to change, okay? Geopolitical risk. The future is totally blind right now, completely and totally blind. But in a rising interest rate environment, I do know that there's going to be a contraction of capital, and I know that that is going to be equivalent to volatility in this marketplace. You sit there and you take it, or you don't. By the way, again, somebody asked, it's TheoTrade.com/blueprint, okay, to get to this particular page. So, oh man, let me answer a couple more of these questions, and then we'll move onward and upward. And again, I'll stay on here as long as I have to answer some questions. So, again, the first one that came in, the name was Richard. He said, I can't make it live. Of course, yes, this class is recorded. By the way, the specific question in here, is it going to, like, how soon after is the recording placed? We put the recording up. We put the recording up literally seconds after. It's instantaneous. Okay, so it's good. All right. The next question. Now, Frank asked, how many times a year should you use the atomic hedge? Frank, you're going to learn that in the class. That's one of the key pieces of the criteria. I can't give everything away. What month you do the options in, if you had the answer to that, you try to place it yourself. You know what? A lot of people will go out and try to place a trade like this themselves, but here's the reality. Okay, I bet you anything you'll lose more than $197 trying to figure out what expiration to use. You like that answer? Okay, it's true though. It's true. I mean, listen, the criteria that we're putting together in this class, this criteria is not just mine. This is stuff that's been derived from traders that I've worked with for, almost 20 years. I mean, it's fair to say that, right? I mean, it is. It's not just, mine. This is a hedge that's been around. I call it the atomic hedge because, and it has nothing to do with like a bomb going off. It's like I said, it's a bunch of electrons surrounding the nucleus, which is your portfolio. Okay. I'm a total geek. Sorry, I didn't go to business school. I went to school for molecular genetics. You want fries with that? So, by the way, purchase the class. You're going to receive an email with a link. How can I access the blueprint? Okay. Everything you're going to get if you, somebody said I just purchased the class, you're going to get in an email in the next couple of minutes. And by the way, as soon as you purchase the class, again, you can go in and the email will actually give you access to all bonuses. The bonuses are in there and don't try to watch them all at one time. By the way, the Greek class alone, there's a session on delta, theta, gamma, vega. Okay. Right there is about 5 hours. And then a position management class, which is another hour and a half. It's a whole nother class unto itself. And then I threw in there the beginner's guide to hedging. This one actually talks a little bit about futures too. And then there's a capital allocation on top of it. By the way, if you're Canadian, can't trade futures, I get it. I totally get it. Okay. That's one of the reasons that I'm doing this with options over there. All right, moving along over here. So next question, Michelle. Michelle said, can never totally get my head wrapped around options. Will I be able to follow along in the class? Yeah, actually, Michelle, one of the reasons that we give those bonuses, the options 201, it'll get your head wrapped around options. If you guys never seen it before, you'll love it. The 201, that alone is worth its weight in gold. Again, I need you to understand just a little bit about the basics of options before coming in again to the Atomic Hedge Strategy course. So moving along over there, Michelle, I hope that helps to a degree. I actually like this one. The next question comes from Alex. Alex said, I've lost a lot of money trading. Is this class going to help? Alex, the whole basis for the class is not to lose money in the marketplace. And again, I feel pretty strongly about that. I know everybody's like, I just want to make the next, $1 million. And, everybody again kind of wants instant coffee, instant tea. And I'm telling you, all right, people look at these short duration trades, but then they forget about the fact that they have this portfolio. And you shouldn't forget about it right now, because since 2009, if you've owned a portfolio since 2009, the S&Ps have traded from, 660 to 2,630 where they currently reside. I mean, when you see 200-300% gains, or if you're in the NASDAQ, you're looking at 300-400% gains in a couple of years, kind of want to lock them in over there. All right. Gloria said, I don't have much time to do this. I work full time. Can you do it? Of course you can. That's in a big portion of the class in the criteria is kind of set and forget the strategy. Okay. Another question actually came in here from John, and he said, I can't get approved for options. We gotcha. If you cannot get approved for options because you're a newbie, we got your back. We have relationships with a number of the brokerage firms. Not to mention, there is one aspect I did not mention over here, okay? And that's this. So if you look at this, we will provide you, if you have a TD Ameritrade account, fine. If you don't have a TD Ameritrade account, that's fine too. This class will qualify you for a discounted rate at TD Ameritrade. I cannot mention what that discounted rate is live. If you ask in the chat room, we can provide that, that information to you. So we will help you get approval. We will help you get approval, okay, for advanced option strategies as well. So I like this one. Next question. I have a six-figure, this is from a Michael. I have a six-figure retirement account and I need to keep it. Okay. Is this strategy going to protect my life savings? Yeah, Michael, that's the entire idea of the class. I mean, that's it in a nutshell. You put the strategy on, the market does tank. Okay. Hey, the only thing I ask from you is, I don't know, write an email afterwards. Hey, it saved my behind from a market. That's fine. All right. Other questions in here. A couple of people asking about the commission rates. Duck, Severson, and Jeff are feverishly answering those. Okay. So, there was an interesting question that came in here from a Tom. It said, okay, in a Canadian account, they can't sell options. So you can use the atomic hedge in a normal margined account, but there would be tax implications for that. Okay. By the way, Tom, you can also check out, there's a number of brokerage firms that we can direct you towards. Listen, if you're Canadian, it's expensive to trade. We can help you out a little bit there. Again, there's a number of different brokerage firms that we can direct you towards. So I like it. Yeah, it's an atomic hedge, not an atomic wedge. So if you guys know what the atomic wedgie is, that had no reference whatsoever. Yeah, by the way, if you are a registered investment advisor, okay, you can apply this concept to your client portfolio. By the way, if you're a registered investment advisor, email me because I've actually got crew that we're affiliated with. We can do everything from consulting. We work with registered investment advisors. There was a period of time where I actually worked for institutional money managers at TD Ameritrade, everybody that $300 million of assets under management and more. So we can advise on that as well. And here at TheoTrade, we also take soft dollars. That basically means registered investment advisors can actually use their soft dollars for that. Again, the address over here is theotrade.com/blueprint. I think I got, by the way, this differs, another Michael in here said this differs vastly from a married put. Okay. A married put will cost you far too much. If you just go out there and buy puts, the puts are going to cost you more than the S&P could probably go up in a year. And that's one of the problems with it. Anyway, the atomic hedge strategy doesn't have that. I hope to see all of you guys at the class again. It's going to be live Saturday, December 16th. It's 10 a.m. to 1 p.m. Eastern time. Class will probably run like three and a half hours, including questions. Again, the class, it's lifetime access to the on-demand recording. So after the live class, you can, on demand is, it's like, it's like Netflix for life. To the class over there, and it's $197. Again, you can't go wrong. It's theotrade.com/blueprint. Again, if you guys have any questions, by all means, email us support@theotrade.com. We're also here to answer it. You can even give us a call, 800-256-8876. So by all means, I want to thank everybody for joining us this evening. If you have any questions, fire them in over here. Be here for a couple of more minutes to answer those. Thanks, everybody. Have a great evening. Bye-bye.